Everyone loves the idea of making passive income, and in today's video, I'll show you what I consider to be the easiest way to achieve that through the stock market, by selling options. I understand you might be skeptical. I was too before I learned the strategy. By the end of this video, you will have all the information you need to start investing and earning passive income right away. You'll learn how I enter trades, choose strike prices, and most importantly, how I close out my trades to consistently collect income on a weekly or monthly basis. So, if you're ready, let's jump into it. Understanding options. The first thing you need to understand is the difference between buying and selling options and what our goal is for each. While you might know the general difference, there is one crucial piece of information we must understand before making any trade. Buying and selling options are complete opposites. When you buy options, you pay a premium for that option. When you sell options, you collect a premium when you sell the option right away and you get cash. The money moves from the buyer of the option to the seller. Since both the buyer and seller are betting on the same option, only one can win the trade. The option either expires in the money or out of the money. The buyer hopes the option expires in the money, while the seller bets it expires out of the money. And this fundamental goal drives the profits for buying and selling options. One important thing to understand is just because you sell an option doesn't mean that the person that bought the option is playing with you until the very end. That person may go ahead and buy and sell the option many more times. It just means that the option that you sold or that you bought, you are playing with that option until its expiration, unless you want to close out that option early. Interestingly, the percentage of winners between buyers and sellers of options are not equal. 90% of out-of-the-money options expire worthless. This statistic doesn't account for actions like closing options early, taking profits, or exercising options. Nevertheless, it means that you have a much higher chance of winning your trades if you're on the other side of selling options rather than buying them. Essentially, if you've been losing money buying options, that premium that you paid goes to the option seller, who's just collected that money. Let's go over an example of the option chain. Let's dive into the option chain with an example using Meta platforms. We'll choose an expiration date about a month out, so I'm going to go to Meta right now, and we're going to pick an option that's going to expire in roughly 30 days. So if I go to, let's just say July 26th as I'm making this video, and we go to sell put option. Let's first of all just take a look at selling call options, because I think it's going to be a lot easier. If I pick an out of the money call option, say 570 right here, and I expand it, you will see that the delta is 0.22. And if I go ahead and sell this call option, that means that the chance of profit here you can see is 84%. That means whoever's buying this option has an 84% chance of losing on this option. And if you're selling this option, you have an 84% chance of winning. This means that literally 8 out of 10 times you will win this trade if you were the option seller. But if you're the option buyer, you're going to lose 8 out of 10 times. Robinhood and other brokers sometimes don't show you the profitability or the probability when buying call options or options in general. Instead, they show you the break-even price, because if people saw that they only had 10 to 20% chance of winning, well, they might realize they're often just throwing money completely out of the window. So for sellers, this percentage is your key to understanding your chances of success. So when it comes to selling puts and calls, selling options can be categorized just into these two categories: selling puts, selling calls. And basically how you combine those is how option trading gets very interesting. So first of all, selling put options gives you the obligation to purchase a stock at a given strike price if the option expires in the money. So you don't want the stock price to drop below your strike price, typically. You must have collateral and cash to cover your position in case you're forced to buy the stock. But if you're selling put options, I want to say that most of the time you want to sell put options in stocks that you already would like to own anyways. If the stock doesn't drop below your strike price, well, nothing happens. Then you can sell the put option again. And either way, you have collected the entire premium. When you're selling options, you collect a premium up front regardless of the outcome. Now, let's talk about selling calls. Selling a call option gives you the premium, but it gives someone else the right to potentially buy the shares from you and giving you the obligation to have to sell the stock if it goes above your strike price. Okay, and when I talk about selling calls, by the way, I'm always referring to covered calls, because if you want to make consistent income, you want to go after covered calls. Covered calls are basically generating income on a stock, and you must own 100 shares in the basic covered call example. So let's talk about the strategy and examples, okay? The first step in selling options is to ensure you have the necessary collateral. Then you select an option to sell, and it's as simple as that. You collect a premium and aim to buy back the option at a lower price if you wish before expiration. There's no reason that you have to hold options until expiration. You can absolutely take profits early, or in my case, I do like to hold options until expiration, because if I've done my homework and research correctly, an option will expire out of the money. Now, I want to go over some examples of selling a put option, because I do have many sell puts in my portfolio right now. It is actually my number one strategy that I like to use over and over again. Let's take a look at a stock like PayPal. I think PayPal has really good support levels right now. So I'm going to go to PayPal and I'm going to trade PayPal options. You can see right now that PayPal actually has gone down a little bit. It was as high as $67, now it's 61. So given that it has pulled back down quite a bit, I'm gonna go ahead and show you an example of selling an out of the money option and the profitability that I would have from selling an out of the money option. So let's go for something like July. You can go for an expiration date that is 2 weeks out, 3 weeks out, 4 weeks out. Anything around that 1 month mark is the ideal time for selling puts if you want safe, passive, consistent income. All you have to do is just sell out of the money options that expire a few weeks out, okay, on high quality companies. So for PayPal, we're going to go to sell put option, and I'm going to scroll down. And for example, let's just say that I'm going to go really safe. Now this would be a very conservative play. I'm going to sell the 57.5 put. You can see here how my delta is 0.21 and my chance of profit is 79.87%. Given the very high chance of profit, this basically means, again, that I'm going to be winning 8 out of 10 times on this trade. However, I actually consider myself winning 10 out of 10 trades on this specific trade because, for example, even if this trade goes into the money, I'm happy to purchase PayPal at $57.5. That would be a very good value for me, so I don't mind collecting $73 to be forced to buy PayPal at $57.5. I'm literally getting paid to buy a stock for a lot less than the current price that the stock is going for in the market. Given that, I think selling put options is an absolute no-brainer strategy that can create that passive income and actually force you into buying high quality, good stocks, good value stocks that you want to own anyways. So in the worst case scenario, you will have to basically buy PayPal at 57.5. If it is above 57.5, then you do not have to buy it. This option will simply expire on July 19th, and on July 22nd, that Monday, this option won't exist in your portfolio anymore. So the $73 is yours right away as soon as you sell the option. From that point on, you don't really have to do anything. All you have to do is hold this position until expiration and it'll expire, worthless if it's above 57.5. If it's below 57.5, you will be assigned 100 shares per contract that you have sold. So if I've sold one contract, then I'm going to get assigned 100 shares per one contract, okay? Now, the other thing that you need to know about selling options is there are some advanced strategies. This is a very simple strategy, selling a put option. There's some more advanced strategies that are not as simple as just selling puts and calls, but they combine options together. So they sell puts and calls, like in the case of an iron condor. An iron condor involves selling an out-of-the-money put and an out-of-the-money call option while simultaneously buying a further out of the money put and a further out of the money call option. This basically creates a range where you can profit if the stock stays between the two sold options. So if you bought options, they act as an insurance to limit your potential losses if you're buying put options. If you're buying call options, you're betting on the stock rising very fast. But if you're selling options, you're basically betting on something not happening. Now, this might sound complicated, but imagine that you were an insurance company. Let's say that your neighbor asked you, hey, I'm gonna go to work today, just a typical day. I'm just gonna go to work 10 minutes down the street. I'm feeling a little bit uncertain today. I mean, maybe the weather is gonna be bad. Do you mind if I get into an accident, you have to pay for that accident? You'll be like, I have to pay for your accident, what? You'll be like, yeah, but I'm not planning on any accident. And let's just say all humans spoke the truth, and let's say nobody was being facetious or trying to trick you in any way. He just had this feeling that he wanted some insurance. Okay, so if he wanted some insurance, you could say, well, sure, Bob or Joe or whoever, right? Say, sure, I can insure you. I'd like $10. That's exactly how selling options works. You're basically getting paid a premium for something not happening. So if your neighbor goes to work and nothing happens, well, all good. Nothing happens. You don't have any expenses at all. However, if he gets into an accident, you have to pay money for his car. But let's say his car is only like $5,000 and you don't have to pay the medical expense or anything like that. You're just insuring the car itself. $10 per day could be pretty decent, right? Because in a given year, you would earn $3,650, almost the price of a $4,000 car. So this would be a profitable strategy probably to run, because if you look at actuarial tables, people do get in accidents with cars, but I don't think the average person gets into an accident once per year. It's probably every few years, and hope to God nobody gets into an accident, right? But that's how insurance companies work. They work by collecting a more expected premium up front, just like a put option works. And then some people will get into accidents, and just like in trading, you will have some losses, but your wins will far surpass your losses. So an iron condor in particular is useful in a sideways market where the stock price doesn't move significantly in either direction. By utilizing the strategy, you can take advantage of the time decay in both the put and the call option. So you can think about time decay very similar to that example that I just gave you, where let's say that the neighbor asked you to insure his car every single day. He's like, I want to pay you $10 per day. I'm going to give you a lump sum of $3,650. I just want you to cover the car. So when you collect that $3,650, it's yours, right? It's yours whether he gets into an accident or not. That $3,650 is yours regardless, right? It's already in your pocket, so it doesn't really matter what happens. Obviously, it matters from a perspective of if he gets into an accident, you have to pay, and then from the ethical perspective, you don't want him to get into an accident, right? Most people, unless it's fraud, they don't do that type of thing. So when you collect that income, it's yours. So you can use that $3,650 to invest. So you can actually invest the premium that you get. So that's another benefit of option selling. When you're selling a put option, you get paid $5,000. I have plenty of students that are making that amount of money. I tell them that cash that you're making, you should reinvest into your portfolio. You can use that $5,000 right away to sell some more options. You can sell some credit spreads. You can also use that money to live on, but I usually tell students, as you're making money, use it to invest in credit spreads. So a credit spread involves selling an option and buying another option with the same expiration but a different strike price. So for example, a bull put spread, right, or a put credit spread involves selling a put option and then buying a lower strike put option. So this strategy limits your risk compared to selling a naked put. Credit spreads can be tailored to your risk tolerance and market outlook. By choosing appropriate strike prices, you can really control a lot of your risk. So when it comes to me, when I'm selling credit spreads, I'm going for something around 14 delta, 15 delta. So my chances of success are 85%. So this flexibility makes credit spreads a very versatile tool, actually a very safe tool to have in your option trading arsenal. Now, when it comes to risk management, I always want to emphasize risk management. I've seen your guys' comments, by the way. I really appreciate your comments. I also really appreciate if you're subscribed to this channel. I pour my heart and soul into these videos because I love what I do. I'm very passionate about this. And when it comes to risk management, I want to cover this basis because it's very important for you guys. I want everyone to have longevity in trading. Risk management is crucial when selling options. And here's a few tips that you need to really understand. The first thing is you need to diversify your trades. Don't put all of your capital into a single trade, even if it's a very safe stock, okay? You can, of course, do that with SPY and QQQ, but you want to spread your trades across different stocks and expiration dates. The second thing is, I don't usually talk about this, but if you're feeling antsy and you want more control of your portfolio, you can set a stop loss order. Determine a maximum loss you're willing to accept and set a stop loss order to automatically close your position if the market moves against you. Especially if you're a beginner, I think setting stop loss orders can really help you. Number 3, you want to monitor market conditions. Keep an eye on market news and events that could impact the stock that you're trading options on. Number 4, you want to use technical analysis. I personally love technical analysis, and I use both Bollinger Bands, RSI, and moving averages to spot opportunities, close trades, and manage trades more properly. While ideally you want options to expire worthless, it's often better to close positions early if they lose significant value quickly. So if you've made 80% of an option in a week and there's still 4 or 5 more weeks left to go, I would simply close that option, take the profits, and reinvest the profits in a better opportunity that can yield you more money. This way, you can free up collateral and open up a new trade, maximizing your returns over time. For example, if you sold an option for 100 and its value drops to 10, well, you should buy it back and lock in a $90 profit and just sell a new option, especially if there's a whole lot more time left. Because what you want to do is you want to calculate your annual return. This is something I cover in my Discord community because it does get a little bit granular. But long story short, if your annual return or your yield on this new position that you plan to open exceeds the amount of money that you're going to make with the $10 left out of 100 in the given time, then it just makes sense to close out that position. Closing your position early also helps mitigate the risk of a sudden market move because the market can have a negative impact on your trade. By locking in profits and freeing up capital, you can maintain a more flexible and responsive trading strategy. My step-by-step strategy is basically choose an option with a high probability of success. Aim for 75 to 80% chance of profit. This means looking for options with strike prices that have a high likelihood of expiring out of the money. Okay, out of the money option selling works very, very well. I have sold out of the money options for quite some time. Specifically when I was working for Goldman Sachs, I noticed just how much money there is to sell out of the money options. And that was a strategy that traders used all the time, okay? Number 2, target 2 to 5% returns monthly. This is relative to your collateral. Calculate the potential return on your investment to ensure that it meets your monthly income goals. Because I don't think this is going to be a problem for most, but a lot of people will aim for something really, really high. And I'm telling you right now, if you're aiming for 10% or more per month, I don't care about the promises out there in the world. There's so many people promising absolute BS and nonsense. If you look at the best investors, they are not doing 10% a month consistently. It is possible to do on a short-term basis, but as you grow your portfolio, you want to be more conservative. For me, with over $4 million invested in the stock market, I am now personally targeting around 2% per month. However, in my community, we're making 4%, 5%, and 6% because obviously I'm taking lots of big trades, so my results are skewed towards lower results now. That doesn't mean my students are getting lower results, it just means that I'm personally getting lower results. In terms of if I were to strip away my large portfolio and just talk about the results I'm getting in my small portfolio, it is 5% or more per month. It is 4 to 6% per month. It just depends on which basket of strategies you look at. I have certain strategies that are earning a lot of money per month, but you want to be realistic and you want to target something long-term 2 to 5% per month. Third thing is to sell options. I personally go 30 to 45 days out. I close positions early if they reach 70 or 80% profit. This helps you lock in gains and minimize your risk. And basically from there, you just repeat the process. Continually sell options, sell put options, sell covered call options, collect premium, and reinvest into your portfolio so you can continue to compound and snowball the results that you're getting in your portfolio. Consistency and discipline are the key to achieving long-term success.